The Federal Reserve is in the middle of a slow, quiet, but deliberate pivot away from the US housing market. Now, you won't hear it phrased this way on the nightly news. You won't see this headline on the front page of the Wall Street Journal. The official statements coming out of the Fed are, as always, designed to be calm, measured, and frankly, boring. But when you look at the data, when you track the money, and when you read between the lines of their own long term goals, a shocking picture emerges. While the media remains fixated on interest rate cuts, the Fed is strategically setting the stage to stop propping up mortgage backed securities, a multi trillion-dollar role it has played for over a decade. Most people, even those looking to buy or sell a home, are completely unaware this is happening. In this video, I'm going to show you the evidence that proves this shift is underway. We will walk through the Fed's own statements, look at the historical data, and uncover what this policy pivot really means. This isn't just an academic exercise. This change has the potential to fundamentally reshape the value of your home and your ability to afford one. I will lay out the three most likely scenarios this will trigger for home prices in 2026 and beyond, and the one that I believe is almost inevitable. This is the story that isn't getting the attention it deserves. To understand what's happening, we first need to understand the beast that is the Federal Reserve, and we have to be honest about what its job has become. Officially, if you ask any Fed governor, they'll tell you they have a dual mandate: stable prices, meaning low inflation, and maximum employment. For decades, that was the entire game. They'd raise interest rates to cool down an overheating inflationary economy, and they'd cut rates to stimulate a weak, job shedding economy. It was a simple, if blunt, tool. But then 2008 happened. The global financial crisis didn't just create a recession, it broke the system. Simply cutting the main interest rate to zero wasn't enough. The patient was bleeding out, and the normal medicine wasn't working. So the Fed invented a new, far more powerful, and far more controversial tool: quantitative easing, or QE. You've heard the term, but what does it actually mean? In the simplest terms, the Fed created money out of thin air and used it to buy financial assets. Think of it like this: imagine the market for a certain type of collectible, let's say rare baseball cards. Suddenly, a new buyer with an infinite wallet enters the market and starts buying up every card they can find. What happens to the price of those cards? It skyrockets. What happens to the confidence of other people holding those cards? They feel rich, secure, and the market feels incredibly stable. That's exactly what the Fed did, but instead of baseball cards, they bought bonds. Specifically, they bought two things: US Treasury bonds, which is the debt of the federal government, and something far more important for our story today: mortgage backed securities, or MBS. What is an MBS? It's a giant bundle of thousands of individual home loans. Your mortgage, your neighbor's mortgage, and thousands of others are packaged together and sold to investors as a bond. For over a decade, the biggest investor in the world for these mortgage bundles was the Federal Reserve. At times, the Fed's purchases made it the dominant force in the market. This had a profound market warping effect. By creating this artificial, bottomless demand for mortgages, the Fed pushed mortgage rates down to generational lows. This was the entire point. They wanted to make it incredibly cheap to borrow money to buy a house, which would, in theory, stabilize the housing market, make people feel wealthier through the wealth effect, and encourage spending to boost the economy. In the process, the Fed amassed a staggering portfolio, peaking at over $2.7 trillion in mortgage backed securities alone. This effectively created an unofficial third mandate for the Fed: financial market stability, specifically housing market stability. They became the ultimate backstop, the buyer of last resort for the entire US mortgage industry. And for years, the market has taken this support for granted. It has become a permanent feature, an invisible hand propping up home prices from coast to coast. But what happens when that hand is suddenly, quietly pulled away? The massive QE experiment came at a cost, and that cost was inflation. After the pandemic, the combination of government stimulus, snarled supply chains, and the ocean of money the Fed had pumped into the system finally came home to roost. Inflation spiked to 40-year highs. The Fed, facing a crisis of its own making, had to slam on the brakes. The first and most visible part of this was aggressively hiking the federal funds rate, which sent mortgage rates soaring from under 3% to over 7% in a breathtakingly short period. But the second and far more important tool for our purposes was the reversal of QE. This is called quantitative tightening, or QT. If QE is the Fed printing money to buy bonds, QT is the opposite. It's the Fed shrinking its massive portfolio of assets. Now, they don't typically sell these bonds outright, as that would cause panic. Instead, they simply let the bonds run off their balance sheet. When a bond matures or when a homeowner pays off their mortgage from a bond the Fed holds, the Fed takes that cash and essentially makes it vanish from the money supply. Since June of 2022, the Fed has been on a mission to shrink its balance sheet. You can see it on their own charts, a massive, nearly $9 trillion peak followed by a steady downward slope. And for the past few years, they have been allowing both treasuries and those crucial mortgage-backed securities to run off up to a cap of $35 billion per month for MBS. But here is the truth that the mainstream narrative often misses, the point that changes everything for the housing market. The Federal Reserve hates holding mortgage backed securities. Privately and publicly, Fed governors have made it clear for years that in the long run, they want the Fed's balance sheet to consist primarily, if not entirely, of US Treasuries. Why? Because holding MBS means the Fed is no longer a neutral arbiter of the economy. It is actively intervening in and subsidizing one specific sector: housing. This distorts the market, picks winners and losers, and frankly, puts them in a politically uncomfortable position. Fed Chair Jerome Powell himself has stated that the Fed does not and should not target housing prices. Their long term goal is to get out of the mortgage business entirely and become a simple, neutral holder of government debt. This brings us to the critical shift. While the media has been focused on rate cuts in late 2025, the Fed has been telegraphing its long term plan. The next logical step in their strategy, a move analysts expect and the Fed itself has discussed, is to alter how it handles its shrinking MBS portfolio. Here's the crucial detail. While the Fed continues to let its mortgage backed securities run off, instead of destroying the cash from those maturing mortgages, it is expected to eventually start using those proceeds to buy US Treasury bonds. Let me repeat that because this is the entire story. The Fed will stop being a passive holder of mortgages and will instead transition those holdings into treasuries. This is the abandonment. It is not a sudden dramatic sale of their entire $2 trillion portfolio. It is a quiet, relentless, and permanent pivot. It signals that the Fed's role as the primary supporter of the US mortgage market is ending. For the first time in over a decade, the housing market will have to stand on its own 2 feet without its biggest benefactor. And the consequences of this are only now beginning to be understood. This isn't just a theory, it isn't speculation. The evidence of this shift and its consequences are already appearing in the data if you know where to look. We are moving from the what to the why this pivot represents a potential repricing of the entire housing market. Analysis point A: the new headwind for homebuyers. First, let's look at the single most important chart for any prospective homebuyer: the spread between the 30-year mortgage rate and the 10-year Treasury yield. The 10-year Treasury yield is considered a benchmark risk-free rate. The mortgage rate is that benchmark plus a spread or a markup that lenders charge for the risks of lending to a homeowner for 30 years. Historically, that spread has been about 1.75 percentage points. When the Fed was engaged in massive quantitative easing, buying up MBS with both hands, this spread was compressed, sometimes falling well below its historical average. This made mortgages artificially cheap relative to other forms of debt. But now, look at what has happened as the Fed has begun its pivot. That spread has widened. Even as mortgage rates have fallen from their highs in 2024 to below 7%, the spread has remained elevated compared to its long-term average. This is a direct result of the Fed stepping away. With the largest, most price insensitive buyer exiting the market, the remaining private investors, banks, pension funds, international buyers are demanding a higher premium to buy and hold those mortgage backed securities. They want more compensation for the risk. My analysis is that this is not a temporary blip. This is a structural repricing. The Fed's pivot away from MBS is effectively a long-term headwind for homebuyers. It means that for any given level of the 10-year Treasury yield, your mortgage rate will likely be structurally higher than it would have been at many points in the last decade. This creates a persistent challenge for the housing market, one that exists completely independent of the Fed's decisions on the federal funds rate. Even if the Fed cuts rates further, this wider spread could keep mortgage payments higher than they otherwise would be. Analysis point B: the rise in listings. Now, let's turn to the market itself. What is happening on the ground? For 2 years, the story was about a lack of inventory. Homeowners locked into their 3% mortgage rates were unwilling to sell and move. But that narrative is starting to change. According to data from Realtor.com in late October 2025, the number of active listings, homes for sale, has climbed 15.1% compared to the previous year. This marks the 102nd consecutive week of annual gains in inventory. In some regions, particularly in the South and West, inventory levels have already returned to pre-pandemic norms. We are seeing more listings than this time last year. While an increase in homes for sale sounds like a healthy rebalancing, we have to ask why this is happening now. This isn't just a seasonal adjustment. We are seeing a divergence between new listings and total inventory. While new listings are up a modest 4.7% year over year, total active inventory is growing much faster. This means that homes are sitting on the market for longer. The median time on market has increased, lingering for over 60 days, which is close to pre-pandemic levels. This tells a story of more sellers entering the market while buyer demand remains constrained by affordability. Sellers who were waiting on the sidelines seem to be listing their properties, perhaps sensing that this is a good time to sell. But they are being met with cautious buyers. Housing affordability is a significant challenge, hovering near the worst levels in a generation. This is the classic setup for a market rebalancing. We have a noticeable rise in supply colliding with a drop in demand, driven by a major affordability crisis. And right at this critical inflection point, the Fed is choosing to reduce its primary support mechanism for the market. Analysis point C, the ghost of taper tantrums past. To understand how sensitive markets are to the Fed's balance sheet, we only need to look back to 2013. This was the infamous taper tantrum. After years of QE following the 2008 crisis, then Fed Chair Ben Bernanke merely suggested that the Fed might taper or slow down its pace of asset purchases. He didn't say they would stop, he didn't say they would shrink the balance sheet, he just hinted at buying slightly less. The result was a global market meltdown. Bond yields shot up, stocks fell, and mortgage rates spiked dramatically. It was a clear signal that the market had become addicted to the Fed's support, and any threat of withdrawal could trigger a violent reaction. Today, the Fed isn't just hinting at tapering, it is executing a full blown pivot away from an entire asset class. The reason we haven't seen a more dramatic tantrum yet is because it's happening in slow motion, and the market's attention has been diverted by the drama of inflation and rate hikes. But the underlying mechanics are the same. By systematically reducing the biggest source of demand for mortgage debt, the Federal Reserve is unleashing a powerful force on the housing market. The slow, steady widening in the mortgage-to-Treasury spread is the 2025 version of the taper tantrum. Less explosive, but more persistent and potentially more consequential. The Fed's actions from 2020 to 2022 directly fueled one of the biggest explosions in home prices this nation has ever seen. It is only logical that the reversal of that policy will have a powerful effect in the opposite direction. The market is standing on a trapdoor, and the Fed's hand is slowly, deliberately moving toward the lever. This all might sound like abstract macroeconomic jargon: balance sheets, treasury spreads, quantitative tightening. But this policy shift has concrete, real world consequences for your personal finances, whether you're a buyer, a seller, or a homeowner. Let's break down exactly what this means for you. For the first time home buyer, if you are trying to buy your first home, you are on the front lines of this policy change. The affordability headwind I mentioned earlier is not theoretical, it is paid directly out of your bank account every month. Let's run the numbers. Imagine you're looking at a home and need a $400,000 mortgage. In the past, the spread between the 10-year treasury and your mortgage might have been 1.75%. Today, because the Fed has stepped back, let's say that spread is now closer to 2.5%. That's a 0.75% difference that is a direct result of this policy pivot. It has nothing to do with inflation or the Fed's main interest rate. That 0.75% difference on a $400,000 loan translates to roughly $200 more in your monthly payment every single month. That's $2,400 a year. Over the 30-year life of the loan, you will pay an extra $72,000. That is $72,000 that goes straight to bond investors to compensate them for the risk the Fed is no longer willing to absorb. This is money that does nothing to build your equity or improve your home. It is a deadweight loss, a structural cost added to the price of home ownership. This fundamentally alters the affordability equation. The median principal and interest mortgage payment in the US has already more than doubled in the last 5 years. This new, wider spread could lock in some of that pain, ensuring that even if and when the Fed cuts its main policy rate, mortgage rates may not fall to levels that would trigger a meaningful recovery in demand. The pool of buyers who can afford to purchase a home at today's prices is shrinking before our eyes. For the current homeowner and seller, if you already own a home, you might feel insulated from this. After all, you have your low mortgage rate locked in, but you are not safe from the secondary effects. The value of your home, your single biggest asset, is determined by what the next buyer is willing and able to pay for it. As we just established, the next buyer is facing a much harsher reality. The number of people who can afford your home at current prices is decreasing. This means less competition, fewer offers, and more days on the market. The days of listing your home on a Friday and having 20 over asking price offers by Sunday are over. Those days were a direct product of the Fed's emergency stimulus, and that stimulus is now being withdrawn. Sellers are already feeling this. Homes are sitting for longer, and price cuts are becoming more common. Your home's value is now facing a structural headwind that did not exist a few years ago. The tailwind of the Fed's massive MBS purchases that lifted all boats is now reversing into a headwind that will press down on valuations. Even if you don't plan to sell, this has an impact. Your ability to borrow against your home through a home equity line of credit, HELOC, is diminished if your home's value stagnates or falls. The wealth effect that made you feel richer and more confident in your spending can reverse, making you feel less secure and potentially leading you to pull back on spending. For the broader economy, the housing market is not an island. It is the bedrock of the American consumer economy. When housing slows, the effects ripple outward. Think of all the economic activity tied to a home sale. Construction workers, real estate agents, mortgage brokers, loan officers, appraisers, and home inspectors all see their incomes fall. But it goes deeper. When people buy homes, they buy things to put in them. They buy furniture, appliances, lawnmowers, paint, and curtains. A slowdown in housing is a direct hit to retailers like Home Depot, Lowe's, and Wayfair. It hits the manufacturing sector that produces those goods. A sustained downturn in housing has historically been one of the most reliable predictors of a recession. The Federal Reserve, in its quest to normalize its balance sheet, is taking a calculated risk. They are hoping the rest of the economy is strong enough to withstand a housing slowdown, but they are performing this experiment at a time of incredible fragility, with geopolitical uncertainty and rising consumer debt. They are pulling the Jenga block of housing support out of the tower and hoping it doesn't all come crashing down. So, where does this leave us? The Fed is pulling back support, affordability is a huge challenge, and inventory is rising to meet falling demand. How does this play out over the next 18 to 24 months? As I see it, there are three possible paths forward for the US housing market. Scenario A, the muddle through slowdown, the soft landing. This is the most optimistic scenario and the one that policymakers are implicitly hoping for. In this version of the future, the market absorbs the Fed's pivot without a major crisis. Mortgage rates remain elevated, which keeps a lid on prices but doesn't cause a crash. The defining feature of this scenario is a frozen market. Transaction volume remains slow. Sales hover near multi-decade lows. Prices don't fall significantly on a national level. Instead, they go completely flat, perhaps rising 1 to 2% per year, which is a loss after accounting for inflation and maintenance costs. Homes take months, not weeks, to sell. Bidding wars become a distant memory. Many mainstream forecasts anticipate modest price growth, aligning with this soft landing view. In this world, the housing market doesn't crash, it just becomes stagnant and irrelevant as a driver of economic growth. It's a soft landing, but one that feels like a recession for anyone working in the real estate industry. Scenario B, the contained regional correction. This second scenario acknowledges that housing is not one single national market, but a collection of thousands of local ones. In this future, the Fed's withdrawal of support acts as a catalyst that lets the air out of the bubbles in the most overvalued markets while leaving others relatively unscathed. We're talking about some of the pandemic boomtowns, places that saw astronomical price growth fueled by migration and speculative fever. These are also the markets that are already seeing some of the largest increases in inventory and price adjustments from their peaks. Zillow's own data projects that markets like Austin and various cities in Louisiana and Florida could see price declines into 2026. In this scenario, these overheated markets could experience a more significant price correction, perhaps in the range of 10% to 15%. This would be painful for recent buyers in those areas, but would not trigger a national crisis. Meanwhile, more stable, less overvalued markets in the Midwest and Northeast might continue to see modest price growth. This is a plausible outcome, but it may underestimate how quickly fear in one major market can spread to others. Scenario C, the downward spiral. This is the scenario that I believe carries a significant risk, yet it's one many analysts are unwilling to fully entertain. In this scenario, the Fed's pivot away from the mortgage market is not just another data point. It is the fundamental catalyst that breaks psychology of the housing market. It works like this: the permanent headwind of wider mortgage spreads keeps affordability critically low. The rise in inventory from nervous sellers accelerates as price cuts become more common. Buyer psychology, which held up for years on the belief that prices only go up, finally shatters. It becomes clear to everyone that the Fed is no longer there to backstop the market in the same way. This could trigger a self reinforcing downward spiral. Falling prices could lead to more underwater homeowners who are more likely to default. This leads to more inventory hitting the market. The lack of Fed support means the market has no artificial floor to stop the decline. This isn't a repeat of 2008. We don't have the same level of fraudulent subprime lending, but it would be a classic balance sheet correction. Prices simply went up too far, fueled by an unsustainable level of central bank intervention, and they must now revert to a level that is supported by real world incomes and market based interest rates. In this scenario, we could see a national home price decline that erases all of the pandemic era gains and then some spread out over the next 2 to 3 years. This would be the most significant housing downturn since the great financial crisis and would almost certainly pull the wider economy into a recession. While mainstream forecasts dismiss a crash as unlikely, they may be underappreciating the unprecedented nature of the Fed withdrawing its biggest support pillar from one of the least affordable housing markets in American history. We have covered a lot of ground, so let's bring it all together. For over a decade, the Federal Reserve acted as the silent guarantor of the US housing market. Through its massive purchases of mortgage backed securities, it artificially suppressed mortgage rates and fueled a historic run up in home prices. Now, that era is ending. The Fed's quiet pivot away from the housing market is a crucial story unfolding behind the headlines. This move is not temporary, it is a permanent structural change that creates a long term headwind for home prices and affordability by ensuring mortgage rates remain higher than they otherwise would be. The data is already showing the effects: rising inventory, falling demand, and more sellers entering a market suffering from the worst affordability crisis in modern history. While a gentle slowdown or a contained regional correction are possible, the evidence I've laid out today suggests that a more significant national price correction is a risk that cannot be ignored. The removal of this multi-trillion-dollar support structure at a moment of peak vulnerability is a major shift that will define the market for years to come. This new environment will create both risks and opportunities. Understanding how this shift impacts different regions is more critical than ever. To see which specific markets are most vulnerable and which may be surprisingly resilient, click to watch my next video where I break down the zip code level data to reveal the most at-risk housing markets in America.